So I'll be talking about stock options today. Just a show of hands, how many people deal with stock options? Yay! Good topic. Good. Okay. Uh, I will. The focus will be mainly on pubco options. I will talk about Canadian controlled private corporation options. Does anyone deal with private company options? Yes. Okay, good. Talking about that too. So hopefully you guys find this useful. A lot of it I think is stuff you guys already know, but I'll also be talking about some proposed changes that may be coming down the pipeline that will affect everyone in this room. So just a quick outline. I'll talk about the tax implications for employers, employees, what happens on a cash outright, independent consultants, which I get questions almost on a weekly basis on, non-resident employees, and lastly I'll go over these proposed changes that everyone's hating right now. So the first one, employers. So many of you know when you have an employee that has stock options and they exercise these options, there is a stock option benefit that needs to be computed by the employer. Hopefully everyone kind of raised their hands in here. You guys are already doing that, so this hopefully is not news to everybody. If there is a stock option benefit, then there's income tax and CPP withholdings required. You'll notice it's not insurable, so there's no EI. And the stock option benefit must be reported on a T4 slip on an annual basis. So prior to 2011, when options were exercised, sometimes cash would not trade hands, and it would be really punitive for the employee to actually have withholding taxes, right? There'd be no cash to pay it. And the CRA actually would allow the employer and the employee to actually not to do withholdings. In 2000, the 2010 budget, they actually changed that in effective 2011, and moving forward, there are required withholdings if there is a stock option benefit. And the CRA basically leaves it to the employer and the employee to figure out how that withholding tax is going to get paid. In our experience, it's usually done as a reduction of the employee's cash salary that they're already receiving. And just keep in mind, there's a stock compensation expense that's often on the financial statements. That's not a deductible expense for tax purposes. So I call this slide employees, but really the employer and the employees, they kind of go hand in hand in terms of things that they need to be aware of. One of the biggest points I think often gets overlooked is that officers and directors are treated as employees for tax purposes. So if you have a director that's exercising options and there's a stock option benefit, you are required to withhold on that benefit. The stock option benefit, how it's calculated, is actually a pretty simple calculation. You take the fair market value of the stock on the exercise date, you subtract the exercise price, and that's your stock option benefit under Section 7 of the Income Tax Act. In terms of timing, the benefit is taxable in the year of exercise. If you're a Canadian controlled private corporation, a CCPC, you actually get to, and you're dealing at arm's length. Like John said, arm's length means you're not controlling it. You actually get to defer the stock option benefit until you actually dispose of the share. So it's a really nice plus if you're in that CCPC space. Assuming the employee decides to hold the share after exercise, the tax cost is essentially the fair market value of the share on the exercise date, plus if they've paid anything to acquire that option, that also gets added to the cost base. And this actually issue came up a couple times actually in the last couple weeks. Sometimes when there is an exercise of options and the employee, for example, doesn't have the funds to pay for the withholding taxes, oftentimes the employer will loan the money to the employee. Be careful about that, because that can actually trigger a taxable benefit if there's no interest paid on that loan. And if you do it really incorrectly, the entire amount of the loan could actually be an income inclusion to the employee. So kind of scary stuff, and you got to tread through that very carefully. So the stock option benefit in itself is almost like it's 100% taxable. Most of you know there's a 50% deduction that's allowed under Section 110 of the Income Tax Act. And that basically gives it like a capital gain type of treatment. Most of you guys know capital gains are only 50% taxable. So if you get this 50% deduction on the stock option benefit, you basically have converted it to like a capital gain. So the 50% deduction is claimable if you meet one of two scenarios. The first scenario, this is the most common one relied on for pubco options. It needs to be a prescribed share, which just basically means it's a plain vanilla common share. The option cannot have been in the money at the grant date. And third, the employer and the employee must be dealing at arm's length. So again, the employee cannot have controlled the particular company. If you can't get into that, the second scenario is if you're a CCPC and you're dealing at arm's length with the employee and you hold the share for at least 2 years, you'll actually get the 50% deduction as well. And there was some confusion last time I talked about this with someone. If you are a CCPC, you can actually still be eligible under the scenario 1. And I think scenario 1 is probably the most common situation where I see people getting the 50% deduction. And honestly, most people get the 50%. I don't even know the last time I've seen stock option benefits without a corresponding stock option deduction. So let's assume that the option is exercised and the employee continues to hold that share and at later on at some point decides to sell that share. So what happens? So assuming the employee holds the share as capital property, any lift in value will trigger a capital gain when they eventually sell it. If the value goes down from the exercise price, you'll have a capital loss. The capital loss is, as many of you know, capital losses can only be applied against capital gains. The really bad part in this situation, though, is if you do have a decrease in value and a capital loss, you can't actually carry that loss back against the stock option benefit that was realized on the year of exercise. So you could have a really bad situation where you're left with the stock option benefit in, say, 2019, you have a capital loss in 2020, and it just sits there until somehow down the road you have a capital gain. So keep that in mind when you're trying to decide if you want to exercise options. And if you decide to sell, if the employee sells the option basically upon exercise, there should be no capital gain or loss because everything's basically captured in that stock option benefit amount. When it comes to timing and valuation issues that you guys should be aware of, so just remember for pubco shares or options, the taxation and the reporting usually occurs when the employee acquires ownership of the share. In 2007, there was a court case where the CRA tried to argue that an RSU, a restricted stock unit, should be valued on the grant date, but the court actually said no, it's actually when the employee acquires ownership of the shares, which happened to be the vesting date in this particular case. The term valuation always comes up as well. People always ask, well, how do we value these options? You know, it's not always, you know, you can't always trade these things. You know, and are there things that can affect that valuation? So the series already come out and said, you know, if there's certain types of selling restrictions placed on the shares, that could actually decrease the stock option benefit. And if there are any potential earn-out clauses that could increase the value, that should also be considered, and that could potentially increase the value of the share and the stock option benefit. So let's just this is a timeline, just so high level you guys understand what happens. So for a public company option, on the grant date, there is no tax consequence. So let's assume the employee continues to hold the pubco options. On the exercise date, you have the stock option benefit and potentially the 50% deduction. Assuming the employee continues to hold those shares, later on there'll be a capital gain or loss, assuming they hold it as capital property. So let's see how this looks like with numbers. It's probably easier to absorb it. So let's assume on the grant date, the exercise price is $1, and at the time of the granting of the option, the fair market value of the share is $1. That's usually the most common scenario. It's not in the money. The employee didn't pay anything to acquire the option and assume that the employee is dealing at arm's length, so they don't control the company. So on the grant date, no tax consequence. So let's fast forward another year and the employee decides to exercise the option. Let's assume that at that time the fair market value of the share has bumped up from $1 to $3. What does that look like? Well, stock option benefit is very simply $2. That's the $3 which is the fair market value minus the strike price. The 50% deduction is eligible. The employee is eligible for the stock option benefit because they received common shares. The option was not in the money on the grant date, and they were dealing at arm's length. So you see the 50% deduction for $1, which is 1/2 of the two. And the net amount on the personal tax return of the employee is $1, and there should be, like I said, withholding taxes on that stock option benefit. One question that often comes up as well from clients is, when we're calculating the withholding tax, what do we base it on? The series come out and said that you can actually calculate the withholding tax on the net amount. So in my example, you can actually base it on the $1 net amount after the deduction and not the $2, which is good. It'll save the employee a little bit of money on the withholdings. So let's say the employee continues to hold the share so they don't immediately sell it, and then a year later they decide to sell it for $8. The capital gain is $8 minus the $3, and so it's $5, and then half of that's taxable, and so you get $250. So in total, the total income that has been reported by the individual is the $250 plus the $1, so $350, which conceptually makes sense because had they bought the option for $1, sold it for $8, you'd have a capital gain of $7. Half of that's $350. So it's just kind of a timing difference of how it all breaks down. So in certain situations, the employee might not necessarily exercise the option. They'll actually dispose of the stock option right back to the employer, and they'll get take back cash or some sort of in-kind benefit. They refer to that as a cash out payment. So in that particular case, the employee is not actually eligible for the 50% deduction unless the corporation or the employer files an election, chooses not to take the corporate deduction, and in that case, the employee can actually get the 50% deduction. So keep in mind, it is an election that needs to be filed. I've seen it in situations where no election is filed and they just assume it's given to the employee. It's not. It's really important that election get filed. So independent consultants. Just another show of hands. Who here deals with independent consultants and getting stock options? Lots, right? A lot of people. I know a lot of people don't want to raise their hands because they're scared of what the tax implications are, which I don't blame you. It's very confusing. There's a lot of confusing commentary about it, about what happens when an independent consultant, so not an employee, exercises options. So all these rules I talked about, the stock option benefit, the 50% deduction, just throw that out the window. It does not apply to independent consultants. So CRA has commentary on this particular matter, and this is how they believe it should be taxed. So on the grant date, if you remember, with the employee, there's no tax implications. For an independent consultant, it's actually different. The value of the option, so not the value of the share, but the value of the option on the grant date is treated as business income. So what the CRA's mindset is, the consultant has provided some sort of service. They've been compensated by getting options, not cash. That is business income, which, I kind of understand that logic there. So what happens on the exercise date? So the CRA's position on this is if there's any incremental value from between the share price and the exercise price, plus anything that was already included as income by the individual, that will actually be income to the consultant. The CRA has already come out and said that income could be categorized as either business income or capital gains, depending on the particular circumstance. So I think a lot of tax practitioners that actually don't really agree with the CRA's position. I don't really like this position either by the CRA. I think when they came out with this commentary, it was probably on the basis that the consultant was going to be providing future services, and hence why they think it needs to be taxed later on once the exercise price, once the options actually exercised. But this one I see is often missed as well. Going back to the previous slide, the taxation on the grant date, we often see gets missed as well in terms of the income inclusion or the income reporting by the consultant on their own tax return. So what other things that should you be aware of if you're an independent consultant and you're exercising options? Remember, with GST, if your services, consulting services, were already considered taxable supplies, you still need to charge GST on that. I know it's a little bit weird because you're not actually, there's no cash that's being exchanged, but technically even in a barter transaction, GST needs to be collected if it is a taxable supply. If the company is dealing with a non-resident consultant and the consultant is providing services physically in Canada, the company is required to withhold under Regulation 105. It's a 15% withholding tax on the value of the services. And then just on valuation, this valuation point kind of applies to both employees and consultants. Mark's going to be speaking later on this, but when it comes to the valuation of options, people always say, well, how do I value this? There's no market for it. The CRA has come up with this comment that it's the greater of two things. One, the trading value of the rights received, and two, the difference between the fair market value of the shares on the option or on the grant date minus the strike price. So immediately, if the option is in the money on the grant date, you already have some sort of income inclusion. And in that particular CRA document, the CRA has said, if the option's not in the money and there is no trading value of the rights, they've conceded that you could potentially have an option that has zero value. Although in my experience, the CRA has always put some type of value. Even if it's a penny or half a penny, they always put something on it. So going back to non-resident employees, to employees, if you're dealing with a non-resident employee, another question that comes up is, when does a non-resident employee have a stock option benefit issue? So it really comes down to if the employee is providing services in Canada. If the non-resident employee, let's say, is based out of the US, never sets foot in Canada, you actually fall outside of the Canadian income tax scope and you don't even have a stock option benefit that you need to worry about. If the non-resident employee is providing services in both countries, let's say Canada and US, the CRA sources the benefits based on the days of employment between the grant date and the vesting date. So if you are in a situation where the non-resident employee is subject to Canadian tax, it's the same tax implications as a Canadian resident. So you'll have withholding taxes, T4 filing requirements, and they'll have to file a personal tax return in Canada. So how many people here have heard of the new proposed changes? Ooh. Not as many as I thought. Okay, well, this will probably sting a little bit. So finance believes that the 50% deduction that I was referring to earlier for employees, they believe that this disproportionately accrues to the wealthiest Canadians, and they feel that this has created unfair tax treatment across Canada. So in June 2019, Finance announced some proposed changes to actually cap the ability to access that 50% deduction. The focus is primarily on public companies, not CCPCs, and if it's enacted, these rules would be effective for any options granted on or after January 1st, 2020. If you have any existing options agreements, those will not be impacted by these new rules. So what are the details of this? So there's going to now be an annual $200,000 limit on the ability to access that 50% deduction. Any options that are exercised that exceed that $200,000 limit will no longer be eligible for the 50% deduction, meaning it will just be almost like a full income inclusion, like it'll be treated effectively like employment income. The key difference here, though, is now the employer will be eligible to claim a deduction for that portion of options exercised that are over and above that $200,000 limit. So from that perspective, I don't know if the government necessarily is viewing this as a money grab. I mean, the employee will be penalized for anything over that $200,000 limit, but the employer will actually get a deduction, which they currently actually don't get. So the other key, it's going to be on a first in, first out basis. So if options are granted multiple times for a particular vesting year, the first ones will be eligible for the $200,000 limit. Anything over that won't be. And again, employers that are CCPCs will not be subject to these new rules. And the finance has also said certain types of startups, emerging companies, if they meet certain criteria, will not be subject to these new rules. So let's look at a simple example of how this would work. So let's assume, I got this straight from Finance's website. So assume Henry is an executive of a corporation that's now subject to these new rules. In the 2020 year, Henry's employer grants him options to acquire 50,000 shares. The exercise price is $50. The fair market value of the share is also $50, so it's not in the money, and these options will vest in the 2021 year. So immediately, all you do is you take the fair market value of the shares on the grant date, multiply it by the number of options that are granted, and you have 2.5 million. You already know that you're over the $200,000 limit, and you're now kind of going to get screwed over on anything over and above that limit. So there immediately, you know, there's going to be some sort of cap on the ability to access that 50% deduction. So the result, the way you calculate is you take the $200,000 limit, you divide it by the $50, which is the fair market value of the share on the grant date, and you get 4,000. So the 4,000 options of the 50,000 he was granted will be eligible for the 50% deduction. So it'll be like the same as the current or the old rules, and the other 46,000 he will not get the 50% deduction, meaning it will just be fully taxed like employment income. So again, remember the stock option benefit is equal to the fair market value of the share on the exercise date minus the strike price or the exercise price. And the other slight difference, like I said, is Henry's employer will now actually get a deduction for all of the 46,000 options that were over and above that $200,000 limit. So just some kind of my initial thoughts on these proposed changes. You know, it's still in proposed stages, so it's not enacted yet. Finance did get industry consultation that ended, I believe, last week. So we'll see if there's any tweaks they make to these rules, but we'll see if there's a new government coming next month, if they'll enact these rule changes. You know, but assuming if we go on the basis that these will go through, and we're all nervous about these new rules, and you're planning to give an employee options, you might want to consider granting them now before the end of the year and not in 2020 once the new rules hit. And I think really the fair market value of the shares on the grant date will become even more important. I mean, that's something that we'd already need to know in order to get the 50% deduction, but I think it'll probably get scrutinized even more moving forward with this new annual limit. So just a recap of my slides. You know, so there is a stock option benefit, you know, that's taxable like employment income. So there's withholding taxes, CPP and EI. There's a T4 reporting requirement. In certain situations, the 50% deduction will be will be eligible to the employee if certain criteria are met. I would suggest documenting that when you guys are doing it. Don't just assume the 50% deduction is eligible. Go, you know, have it in your file of which scenario you meet and why it meets that. You know, if there's a later sale of the share, that could trigger a capital gain or loss. Independent consultants, remember, if you leave, when you leave here, just remember the stock option benefit rules do not apply to independent consultants. They have very different rules, and they're often confusing, and these are the things that the CRA has been attacking lately. And then just remember there's some proposed changes that may be coming down the pipeline.